My name is Michael Guyad, publisher of the Lead Lag Reporters. Joining me for the hour is Hari Krishnan, who has authored two books, recently interviewed me on Top Traders Unplugged, and has a lot of experience, a lot to say about the current environment. Ari, for those who are not familiar with your background, introduce yourself. Who are you? How did you get involved in markets? What have you done in your investing career? And what are you doing now?
There's a lot to unpack there. Well, thanks for having me, Michael. I'm currently a hedge fund manager. I specialize in volatility strategies with a bias toward protection over relative value. I used to be a currency macro manager and an absolute return manager in the UK for many years. Before that, I worked at Morgan Stanley on the asset allocation front. And prior to that, I was building various models for hedging correlation risk in the options markets. Finally, I do have a PhD. Don't be intimidated by that because it's so old. But I did do applied math and notably chaos theory back in the day. So there you have it.
I feel like chaos theory studying chaos theory is perfect when it comes to more dynamic markets, right? Because small things can have massive impacts. Talk about some of the aspects of chaos theory for a moment, and if any of that applies to your way of approaching markets.
Yeah, I mean, I've been trying to use chaos theory for decades, and it's now become apparent to me that it is pretty useful, especially with regards to the Fed. And one of the big problems going on now is that even if you believe that monetary policy has definable outcomes, both in terms of stimulating growth in deflationary regimes and harnessing inflation in a regime like now, the problem is that there are two different lags. It takes longer to harness or to control inflation than it does to stimulate growth, which means that the Fed is kind of on a mission whereby they have to crush the economy, or at least the markets, before they can really do anything about inflation. And that, in fact, is the rosy case, because there are many arguments to be made that the Fed really can't do that much. And it's really just a confidence trick. But I think looking at the sensitivity of policy to delays, to lags, is pretty significant. And that goes back to chaos theory, where a small change in the lag can have a big impact on what happens in the markets.
There is this argument that these lags in monetary policy, the transmission has shortened over many years, that every cycle, the efficiency, in quotes, of the market responding to the Fed is more than before. Do you buy that argument, or is there more randomness when it comes to the length of a lag than people maybe realize?
Well, I think it may be the markets react more quickly because they believe that what the Fed said, or at least historically, they believe that what the Fed says is going to have an impact, and markets do react more quickly to news than they used to. Having said that, it does take a while for changes in, say, bank reserves, even if banks are willing to lend, to funnel into real lending, an increase in deposits and debt, and then into the economy. So I think the lags are unavoidable at some level, but it may be that markets react more quickly.
Yeah, I think that makes sense. Now, you talked about running absolute return type of strategies. That term absolute return is often used. I use it, also within my own strategies. But the term, I think, also causes a degree of confusion because it implies that you're going to always have positive returns year after year, when in reality you can have years of losses and then one year that not only makes up for the prior years but then helps you to overtake it. How do you think about that term absolute return in a chaotic market environment?
Yeah, that's a great question. I mean, I use the phrase, but I'm not sure I like the phrase that much, because absolute returns typically mean that you've neutralized something like the effect of the S&P on your portfolio. So you've neutralized direction, but any portfolio is going to have bets implied in it. And so even if you neutralize direction, you still may have a volatility bet or a sector bet or a capitalization bet. You can go down the line. And one of the hard things now is that if you were trying to reduce risk, let's say by buying bonds or using bonds, which has worked enormously well since the early 80s, it wouldn't have worked this go around, simply because we've been in a very unusual regime whereby stocks and bonds have gone down together, and bonds have actually gone down more than stocks in many cases.
And that's that reference to hell, right? That I said on the
Yeah, I do read it. I love reading that stuff, and few period understand that. I would say.
right. No, exactly. But this is sort of the challenging thing. So ultimately, when you're in an outlier, in an anomaly, you have to make a decision. Is the anomaly representative of the future, or meaning that there's a structural break in causation, or is it just one of those junctures in an approach where you have to take the pain? Right now, I'm more in that latter camp, right? Because
Mhm.
there is still
Yep.
causation, presumably in terms of bonds, in particular treasuries, as a quote unquote flight to safety play. But talk about from a hedging perspective, what do you do when you're in a cycle that you haven't really seen before in the data that's available?
Okay. Well, I mean, for me, hedging has two fronts. One is hedging against a risk event, a downside risk event, and the other one is hedging against a kind of an inflationary shock. Hedging against a risk event for me typically involves some combination of index puts or put structures and plays on volatility across markets. So it could be a wide range of things. But basically, I'm trying to profit from uncertainty or an increase in uncertainty or a directional down. On the inflation front, it's a little bit more complex, so I'll get to that later. But going back to your point about bonds, are you going to stay the course? Are you going to bail out? My personal opinion, which is worth whatever, is that bonds will have a resurgence given that once the Fed either breaks something or conditions stabilize. So I think the case long term for treasuries is pretty good. For longer duration treasuries is pretty good. Um, I can't speak for the audience, but what I would say is that if the Fed keeps pressing on like this, we will have a deflationary shock with a reasonably high probability. If the shock is severe enough, then bonds are likely to rally and rally hard. The question is when. And so, one of the things I've been very focused on is looking at the market's implied Fed pivot, let's say using the Fed funds futures, looking to see how much it moves around over time, and also looking at the quality of returns in the treasury markets over time. So, if you'd gone short treasuries, this is a cherry picked case, at the end of July, you would have had almost uninterrupted good performance, a huge Sharpe ratio until late September. Now things have become choppier, which I think is indicative of more of a two-sided market in bonds, which may in fact point back to the fact that simply being short treasuries is no longer an easy one-way trade.
Now, that point on the deflationary shock, I think, is worth focusing on because it keeps going back to this thing I've been recently saying, which is that the end of the world is the bull case. And I know that sounds dramatic, right? But I had Mark Faber on yesterday. He kind of alluded to the same idea that he's seen this before, where you have some feeling that there's a cataclysmic event coming. The dollar strength, I would argue, is not only a signal of that, but also a cause of that, which we can talk about from a sovereign debt perspective. But the dilemma with the deflationary shock, and I've been in that camp myself, is that if it happens with a very high leverage starting state, it becomes increasingly harder to come out of it. Right? So you got $31 trillion of government debt, whatever, 370 trillion of global debt, depending upon what estimates you're looking at. That's
Yeah.
only been going higher and higher. So it seems to me that if you were to have some kind of exogenous deflationary shock, you on one hand you can argue the central banks want to see that. On the other hand, you can argue that that sounds almost like a system reset again, given how much leverage there is. So how do you kind of think through those dynamics? Because there's systemic risk, right, which can be countered by the Fed, and then there's Fed risk, which may be the systemic risk.
Yeah, this is a really deep and interesting question because even though there's a huge amount of debt out there, you pointed to the 70 trillion number for US treasuries and the 350 plus trillion number for outstanding debt globally, there isn't enough debt to really support the international lending markets. Michael Howell is really an expert in this area, and I would encourage you to look at his work too, which I'm sure you know of. But basically, there's only about 20 trillion of treasuries that can be recycled in the global economy to support the eurodollar lending markets and the other global lending markets. So at some level, there's actually a shortage of treasuries. And this is creating a very awkward situation where there's too much debt, but too little collateral to support the rolling over of debt over time, which I think is kind of a slow motion collision of two forces, one of which is excessive indebtedness, and the other of which is a lack of ability to maintain to roll over the debt over time. And as you pointed to, as you alluded to, that's one reason why the dollar's been so strong.
Right, and I guess the question becomes, how long can that persist? It's like I put out that tweet before the Bank of England stepped in last week saying, how do you create a financial crisis when your collateral shrinks rapidly, which is what's happened, right, with the rise in yields and obviously then the prices of treasuries, the safe collateral in particular, and gilts, right, kind of all in the same camp, right? So this is why I think this is a very asymmetric juncture. I almost feel like the equity markets are like an option themselves now at this point. Either you're going to have a deflationary bust, there's not enough collateral, in which case, you're talking about chaos that could be unlike anything we've seen, right? Or it'll be okay.
Yeah, but it's a very weird equity market because if you look at things in isolation, if you forget about bonds, what do you have this year? You have a garden variety bear market. You have 10 months, the S&P, let's say, is down 20%. I know there's a lot of damage elsewhere, but we came into the year with a high level of volatility, just using a barometer like the VIX. The VIX was ranging between 17 and 30 in December of 2021, which suggests that people were already somewhat defensively positioned in the options markets. And what's followed has been probably the worst scenario for many people, namely tail risk hedging has not been very profitable, but the market's gone down a lot. And so if you look at things purely in equity land, which I think is a little bit misleading at some level, but also insightful, you'll find that we've just had an ordinary bear market. The problem is nothing else has been there to bail out investors in a multi-asset class diversified portfolio.
Right, and it's been odd in that it's actually had a certain degree of consistency in the decline. Right, so the nature of most bear markets, correct me if I'm wrong, is that you tend to have big downs, then a couple of ups, then big downs, a couple of ups, right? So the sequence is more concentrated in a few weeks or months, less in terms of the persistence of weekly declines. And I put out that stat before. You look at the number of weeks that the S&P 500 has lost money this year as a percentage of the year. You're at around 64%. The last time you had so many weeks down as a percentage of the year was 1931. Right, so obviously, including all the other prior bear markets, the sequence has also been, I think, frustrating, right, for those that are trying to hedge this.
Absolutely, and conditions have changed. If you look at 2010 to 2021, let's say, what was the best way to play the equity market? Well, if you were long or levered long with a deep out of the money piece of insurance, let's say a deep out of the money put, you'd do fine because the market was drifting up strongly. And then there were these episodic flash crashes, let's say in 2010. There was a big down move in 2018. Of course, there was the COVID stuff and a few other instances like the Volmageddon. And they were short lived, very severe, and then the market started drifting back up again. So anyone who conditioned their strategy purely on the equity index dynamics from 2010 to 2021 would have been really offside this year because it's been entirely different. As you point out, many down weeks, the majority of weeks have been down. The movements haven't been that severe on the downside. The upside moves have been symmetric with the downside moves, and the cost of insurance has been consistently and stubbornly high. So it's created a different environment for equity index allocators.
Right, and I think that's the point. It's like when you're saying the cost of insurance, insurance is meant to be more for magnitude, not necessarily duration of a kind of gradual week after week of decline. This is where I think there's a degree of frustration around those who have said the VIX should, in quote unquote, be higher given the conditions, right? But and actually, Jim Carroll, as he is up here, Jim, I work with at
This is
Curious.
an excellent point, and as you probably know better than I do, things like the BXM, the buy right index, had a really underwhelming decade of performance in the 2010s simply because markets were rallying strongly and you didn't harvest enough from the coal sell. And now it's been quite different where volatility has been high but it hasn't exploded, so you can harvest a lot of premium. And in a downward trending market, it's actually been a very attractive trade. The question is whether we do have that spike which creates a bottom in the equity market. Perhaps that's overly simplistic. From where the markets will rebound at some point. We haven't really had that. There's been no puke. It's just been a steady downtrend.
Right. It's been constant nausea. I think it's the way to
Yeah,
say it as opposed to the puke.
yeah, yeah. It's quite surprising in some ways, at least relative to the recent past.
Talk about for the audience here, Hari, and I know this sounds like very rudimentary, but I do think this is important to talk
Sure.
through the difference between a hedge and a diversifier, right? So to me, it's very simple, right? The hedge is about the sequence. So historically, usually high volatility periods for equities, the correlation of long duration treasuries to equities tends to flip. So you might have a longer term correlation of around zero, but in those moments in time, it does act like a quote unquote hedge in that it acts inverse on average, certainly not this year. But it can also be a diversifier, right, in terms of long cycles. So talk about that distinction, because I think this is where a lot of FinTwit does get confused by terminology.
Yeah. Well, I mean, the implication is that a hedge is actually related to the cost of running your business. So if you want to be long and you are worried about certain unpalatable downside scenarios, you hedge. And hedging, on average, at least in the median case, if not over the cycle, if you forget about compounding, has a negative expected return. It costs money to hedge. Whereas diversification is a bit different because your diversifying assets very frequently will have a positive return. And so fixed income was a glorious place to be from, say, 1981 or 2 to the recent, up to 2021, let's say, or 2020, simply because you had a positive carry asset, both in terms of rolling down the yield curve, but more importantly, just having positive returns as yields came down, as the level came down, but something which also defended in periods of stress. And I think it was a glorious time to be invested in fixed income. Fixed income, in my view, was, at least on a risk adjusted basis, a far better performer than equities, at least globally, over 3 decades. And that is more the nature of diversification. If you can find an asset that you think will actually have a positive return, even if the stuff you're protecting against is flat or somewhat up, that's diversification. Hedging is more doing something that allows you to stay in the game over the cycle, where you don't have to make bad decisions, you don't have to dump at certain stop levels, implied or explicit, and where you don't get to participate in the big rebounds, where you don't capture a risk premium when it's highest, simply because you're flushed out. So hedging is a negative carry game. If you do it well, maybe you have break-even characteristics over a cycle, or even better, but it's different from diversification in that respect.
No, actually, I'm glad you use that term negative carry, because this is why, at least from a backtest systematic perspective, treasuries, you can argue, are a better hedge because there's some positive carry, because you get a yield if you're wrong in the timing of your hedge. Even though obviously you don't get the same magnitude, at least there's opportunity to make money if your signal says play defense and the market keeps going higher.
Yes, absolutely. I mean, my business is predicated more around the idea that if you want to hedge, there is a relatively efficient hedge all the time. It might not be the best absolute hedge that you could put on if, just to take an extreme case, the VIX were at 9. Maybe there are lots of good hedges that have a lot of power, but there's always something you can do. And that's the premise behind the second leg down concept, that there's always a hedge that is relatively efficient given the state of the world.
All right, so let's tease that out here. And by the way, on that point about Sharpe ratio, I put out that tweet a couple of days ago. If you looked at the Sharpe ratio risk adjusted metric for the S&P in 2008, it was negative 1.84. If you look at the Sharpe ratio for the aggregate bond index or an ETF like an AGG or BND this year, it's negative 1.98. So the risk adjusted returns on bonds this year are actually worse than the risk adjusted returns for stocks in the
Yeah,
great financial crisis, which is utterly remarkable when you think about the perspective of what bonds are supposed to be for conservative investors.
indeed. Absolutely. Absolutely.
So on the second, so let's talk about the second leg down. So that the book you wrote, talk about the premise behind it, and in that
Mhm.
point about sort of there's always something that you can hedge with. It's I'd be curious to hear your thoughts on how do you identify regimes where the better hedge is likely to be something different, because I think that's largely, you can argue, the dilemma this year. Right, treasuries
Absolutely.
historically are a better hedge, but maybe there was something with hindsight that could have told you, well, instead of treasuries would be gold or be the dollar or something else.
Well, the premise for the second leg down started in 2008. And it was based on a very simple observation, which was that in September of 2008, which was a bad but not horrendous month for, say, the S&P, the riskiest stocks had the highest increases in option premium. To put it more technically, if you looked at the implied volatility, the options implied volatility of each stock in the S&P 500, and looked at how much it changed in the month of September in 2008, what you'll find is that the riskiest stocks had the biggest jumps. So, as expected, the riskiest stocks became relatively more risky. But the situation flipped in October 2008, where the Walmarts and the Johnson and Johnsons of the world actually had a bigger absolute jump in risk, in options implied risk, than the risky stuff. And so that got me thinking, and I started to scratch my head, and I wondered, why is it that safe looking assets became risky in October? Well, it's because in periods where markets are down somewhat, and investors are risk averse and portfolio managers want to keep cash deployed, what they do is they rotate from what's perceived to be risky into what may be perceived to be more conservative. But when conditions get really bad, people just sell whatever they have. They have forced liquidations, they have redemptions, they have margin calls, they hit their risk limits, you can go down the line. So they just sell anything. And I think that's something that's been going on recently, where you would have thought that the safest assets are treasuries, even medium to long duration ones. But in markets that are not functioning properly, the distinction between safe and risky becomes blurred. So, how does that apply to the current state of the world? Well, there are a few anecdotal ideas that I'll present very quickly. One of them is that when inflation is low, cross sectionally, if you go across countries, it's well known that on average, price shocks, let's say oil price shocks, tend to mean revert very quickly. So inflation may pop up here and there in the CPI basket, let's say, but it dies down pretty quickly. But when you go beyond a certain level of inflation, it may well be the case that the correlations across the basket go up. And what that means is that if you have various commodities, let's say, which drive prices within the CPI basket, and some of them have gone up a lot and others haven't, you're back in the second leg down zone where maybe you want to try and hedge against sharp increases in the stuff that's lagged. And so these ideas recycle themselves in various ways. And I think one of the ideas in the second leg down is to find areas where, if conditions get a lot worse, risk will go up there, even if it hasn't yet. And the other idea is how to rotate from certain types of hedges in complacent markets, where you can just be a buyer of insurance, basically, and warehouse it, put it in the drawer, and wait, to being more active, trading spreads, swapping out trade hedges that rely upon volatility expansion to other kinds of hedges that are more gamma style, meaning that they just profit from sharp price moves and things like that. But that's all broken down in the book, and it's based on the idea that there's always something you can do. And as someone who does this for a business, at least one line of business, I can't expect that I'm going to get tons of business when everyone's complacent. People usually give me a call when they're a bit worried. And when people are a bit worried, the price of insurance has usually gone up. So I needed to have creative ways to hedge, even if risk or anxiety levels had gone up in the market.
Let's talk about that anxiety point, because there are a lot of uh, tweets around this comparison of the S&P to the 2008 behavior. Um, when you see a lot of, for lack of a better way of saying it, doom porn, right? A lot of kind of
Yeah,
bearish things that are left and right. I understand, obviously, you're probably going to be more systematic and much more methodical from a quant perspective. But when
I'm
you
trying.
see
Yeah.
sentiments, right? When you see sentiment that way, does that make you rethink anything as far as your current positioning, or do you basically just stay to your approach?
Well, there's a short term, a medium term, and a long term outlook. And I use a lot of this stuff. I don't use all of it, and I use some other things, but I'll give you the more um, mainstream interpretation of it. In the short term, why did we have a bounce? Or I can't really say why, but if you look at the dynamics up to September, well, actually up until the end of September, you had a really long series of down days. It's pretty rare to have significant down moves that occur day after day after day. I think September the 19th to the 26th was a succession of all down days for the S&P. That's pretty rare. And if you look at things like short interest, which is largely driven by market makers, the indicators were pretty bullish short term, given the persistence and to some degree the severity of the sell off coming into this month. That has all kind of gone. I mean, we had a big rally over the first 2 days. We've reversed a bit today. But so short term, you can look at things like what is the run rate of down days versus up days. Not that that I'm violating the notion of flipping a coin, where I of course, if I had six heads in a row or six tails in a row, that doesn't say anything about the next flip. But here it is, to some degree, an indication of sentiment. Over the medium term, I think trends are quite significant. The downtrends are still strong. They're still solidly in place, especially in the Nasdaq, to a lesser degree in the S&P, at least until recently. So it's hard to fight the tape too hard. I'm not saying that I use trend following in the various programs explicitly, but leaning on positions in the direction of the trend tends to be safer, at least if you do it in multiple markets, than trying to fade a move where the price action isn't giving you any help. Over the long term, I think there are major issues because even though the amount of debt has gone up dramatically over the years, a back of the envelope calculation would say that the total liabilities for the non banking sector in the US maybe went up 2 to 3 times from 2010 to 2021, whereas the equity markets maybe went up 4 or 5 times. So if you look at the level of equity ownership relative to the supply of debt, it's still very high, even given this recent retracement. So the long term case in terms of expected returns for stocks is not very good. Now, I can say all this and I can try and present a bearish case, but I should caution the audience, which of course most people know, which is that when you try and short the market, which is different from what Michael is obviously doing, when you try and short it directly, you suffer in terms of very low quality of returns. Down markets, on average, tend to be more volatile. They're more severe reversals. They're more squeezes. So going in and presenting the Armageddon case is all well and good. It may be that the endpoint is significantly lower than where we are now, but trading that with a dedicated short position can be really tough. And so, if I had to say, I'm pretty bearish now, but I am always conscious of the fact that I need to manage the path that the market takes from where it is now to where I think it may be, with a wide band of uncertainty in a few months from now.
I'm glad you say that, because I keep using that line that bear markets make fools of bulls and bears, right?
Sure do.
Because
Yeah.
right, what I'm alluding to there is the path and the volatility, right? And it's funny because I was listening to the top traders unplugged podcast that you and I did, and at the end, the question was, when I brought up this point that when you're in an uptrend, you're basically short volatility, and the individual was saying, well, he didn't necessarily quite understand that idea, but you actually just directly hit on it, right? So usually when you're in a quote unquote downtrend, volatility is higher. When you're in a quote unquote uptrend, you tend to have more streaks, lower volatility. And I've always viewed trends not in terms of direction, but rather conditions favoring a certain path, right, in market movement. This is why shorting, to your point, is very, very difficult, right? So it seems easy to look at a chart and say, okay, I'd short here when you're below moving average, and I'd cover here the moment you cross it. But if you were
Yeah.
to actually back test that over time, it really doesn't work. It might work in certain instances, but it's not really a repeatable approach, at least from the studies that I myself have done.
Yeah, well, our theory internally, without going into great detail, is that shorting requires a huge degree of dynamism in your trading. So your holding periods have to shrink quite dramatically, and you cannot sort of be too rigid in terms of holding on to a short position, at least in an equity market. So if you look at down markets, as you point out, the run rates on the downside tend to be shorter. So you do need to be a lot more nimble in the way that you manage the position. Now, one good thing about using options is that you can trade dynamically around your position, around a core position, if you do have insurance that's solidly in place. So you can be more of a contrarian, a little bit more of a minnow, and trade around a static put position or a static downside insurance position more easily if you do use options.
Yeah, no, that certainly makes sense. Okay, let's go back to the point about fragility. And by the way, everyone here, please make sure you follow Hari Krishnan here on Twitter and check out his various media appearances, as well as him doing a phenomenal job as a host himself with the Top Traders Unplugged podcast. So, okay, fragility. Fragility is an interesting term. Even though Nassim Taleb kind of shot me down a little bit when I said that stocks and bonds falling were the black swan. He said, no, I counter that based on past behavior, but never mind that because I'm a fan of his work in anti-fragility. But
Sure.
talk about some of the dynamics today compared to, again, 2008 in terms of market structure, fragility. Are we in an environment where things can break harder and faster than 2008? Are there any real parallels? Talk through that for a bit.
Yeah, well, some things are riskier and some things are less risky. So I'm guessing, this is a bit of a cheap comment, that regulators, the one thing they don't want to do is have exactly the same thing happen twice, the same Armageddon occur twice. So 2008, what was the problem? It was the opacity of the interbank lending markets. It was excessive leverage, the excessive warehousing of risk by banks, and the lack of high quality collateral, highly liquid collateral backing global lending. Now, of course, there was a lot of repo activity and a lot of collateralized lending back then, but what did they wind up doing? Well, banks are much safer now. I know there have been recent tremors within Deutsche and so on, and Credit Suisse, but bank balance sheets are smaller, and banks usually act as agents instead of principals, which means if someone, let's say, wants to buy an illiquid bond, they'll try and source a seller before they'll do the trade. And so what do we have now? We have a situation where banks are acting as intermediaries instead of warehousing risk, and market makers, who are increasingly in the high frequency camp, are incentivized but not required to provide liquidity. True, these entities were never required to do so, but now they perhaps switch off their systems even more rapidly and drop out of the market. So what you have is now a situation where banks are safer, but the degree of available liquidity is less. And so you do see less depth in markets, even if the best bid and ask are pretty tight. You don't know what size is underneath. You don't know how solid the stuff underneath is. So in terms of a microstructure perspective, I think markets are much riskier than they were in 2008. And that's precisely because the risk has gone off the bank balance sheets and someone else has to take it. And that reduces the supply of available bids and offers over time. So you could more easily see cascades. Now, the other big thing which people like Mike Green have talked about is passive investing. Now, we don't really know what the real impact of passive investing is in a quantitative way. We don't know what the breakpoints are. We don't know at what level, if passive investing accounted for, let's say, 60% of all equity investing, if that would lead to a breakdown in the system, or if the number is 70% or whatnot. We don't really know much about this, but what we do know is that there are feedback loops between flows and performance. And flows and performance are important because if the equity market's going up, there are more inflows. The passive investor doesn't, the passive ETF or vehicle doesn't hold cash, it just puts the money to work. That creates a natural bid. And the bid is more than $1 up in the equity markets per dollar invested. It's probably for many assets, it's more like $5 for every dollar invested. So at the margins, it has a huge impact. And when that goes away, the flows go in the other direction. And when the flows go in the other direction, you wind up with a situation where cascading sales are more likely. So it's not a breakdown in the banking system, it's a change in the dynamics of buying and selling that's made this market more fragile.
I'd also add, I think it's also the fact that more time has passed in terms of pension liabilities, right, and having to pay out those obligations, right, which is partially also the story of what happened last week with the Bank of England. I don't know how much work you've done looking at pensions, but this has been sort of a lingering crisis that people, I think, are aware of, but don't seem to want to think too much about.
Yeah, it's the next thing on my desk. There's always a big stack of stuff. I don't know really how levered the pensions industry is in the US. And I know there's a sharp distinction between public and private pensions in the US as well. In the UK, I was surprised to see that they were applying that much leverage, or some pensions were applying that much leverage in an attempt to create duration. That is a very scary idea because the whole point of getting duration is so that if rates go down, you don't lose solvency from an accounting standpoint. In other words, if the discount rate goes down, you need to have a gain in your portfolio to offset the increase in the present value of the amount you'll have to pay out over time. So it's almost not even a real P&L thing. It's more an accounting hedge. You're hedging against solvency as determined by this method. And to think that people or that entities were leveraging their duration that much when it's just supposed to be a plain vanilla hedge, frankly surprised me. And I would be very scared if we had similar things going on in the US. I really just don't know enough. That's the next thing on my mission list. So
yeah, and I think that's kind of the boogeyman, right? It's kind of like that old saying, you never just find one roach in a hotel, right?
yeah,
Right. So it could very well be that there's other looming crises that this yield spike could cause that we're not seeing just yet, either because things are not being marked to market for whatever reason or whatever it would be. But I think it is a cautionary tale of how there's still these tails that are just not visible starting to wag.
yeah, it always makes one worried, these sorts of things, because there is so much interdependence in global financial markets. The network risks are so large. I mean, one of the points I tried to make in the second book, at the risk of shilling my work, is that most crashes don't occur based on a piece of external news that is surprising and comes out. Of course, there are things like 9/11 that cause a very sharp move, but those moves tend to be they don't tend to be followed upon by a series of subsequent moves. What really drives major sell-offs is network risk and deleveraging across the system in sequence. And that's what's worrisome here. And as I said, I don't think the banks are the centerpieces of the network risk as they were in 2008, but the level of interdependency is still extremely high. So it is a worry.
Let's go back to that point about passive investing, because I had Mike Green on a couple of times, and I've used that term structural insanity, right? That you have this money that's automatically going into the Vanguards of the world and various large cap passive indices, and
Yeah.
the wealth effect really isn't from small caps. It's from the wealthy really holding large caps, and everybody else who's not wealthy just taking a portion of their income automatically and stuffing it there under the idea of efficiency. Um, I've always been struck by the Grossman-Stiglitz paradox from the early '80s. The idea that in order for passive to work, you need to have active opportunities, and for active to work, you need to have passive extremes, right? That the pendulum has to swing back and forth. Because if everybody goes passive, then the anomalies that active managers were seeking uh, suddenly come back because there's less money arbitraging it. And if everybody goes active, then suddenly there's no more opportunity, so you want to go cheap beta, right? So there's always this kind of swing there. This is often a talking point on traditional financial media: active versus passive. Oh, active should do better, blah blah blah. But I'm curious to hear your thoughts on, first of all, how do you actually define what an active strategy is? And I say that because a lot of people claim they're active, but they're just overweighting by 200 basis points Apple, and they right, and they claim they're active because of that. But talk about this active passive debate in the context of Michael Green's work, and which you just referenced, because presumably there are going to be opportunities to arbitrage new anomalies, but you've got to have some persistence in a passive bear market for that to be the case.
Well, there was some work done many years ago by some people at the Santa Fe Institute. And basically what they did was they created a model of the stock market where there were different types of traders. There were value investors who bought dips in prices of assets. There were momentum traders, and then there were noise traders who just traded around small fluctuations. And what they found was that if the proportions of them got out of whack, you could get wild moves. And I don't think they explicitly included passive. And I know passive can involve a heck of a lot of rebalancing and trading. But I think the basic idea is correct, which is that, and it goes back to the Stiglitz-Grossman remark that you made, where if there isn't an adequate supply of active managers who buy dips or who hold cash when markets rally and deploy the cash when markets sell off, you no longer have that natural buffer in the system. And that is very scary because what you wind up with is a far more momentum-oriented market. And even this year, we've kind of seen that. There's been a lot more momentum, even though it hasn't been violent. And that may well be because the marginal value buyer is gone, whether it's a bank or more likely a long only or a value oriented equity fund manager.
Do you blame it on the Fed, on ETFs? I mean, Michael Green's made that point that I think it was in 2012 there was some regulation that effectively encouraged this kind of passive large cap flow. What's the source of this dynamic? Because it's not something that's always been there throughout time.
Well, I think the belief that money managers have that they can outperform the market is very, very important for our society. Now, it is true that many will not. But to try and commoditize investing so that you give godlike status to the indices, which are, again, artificially constructed at some level, while diminishing the importance of people who are trying to identify value in our system, I think it's very unhealthy. And obviously, the winners in this marketing campaign have been the providers of passive investment vehicles, such as ETFs. And I won't name names, but everyone knows who the names are. I don't say they're wrong, but their success has been too great. And that's one of the problems that that markets often have. It's a bit like foxes and rabbits. If there are too many foxes, all the rabbits die out. If there are too many rabbits, they eat all the grass and this and that. So you get these wild cycles. Here, what's happened is that the marketing victory was won by the passive community, and it's gone to the point where they'll create their own demise at some level. It's the same thing as if you had a wonderfully successful strategy that was incredibly consistent. Eventually, other people would find out, unless you had some kind of intrinsic technological edge. And so the edge, the added return or the alpha in that trade would probably decline over time. Here it's even worse because you get destabilization. If 100% is passive, at the singular limit, we know that there's no buyer. There's no marginal buyer. So markets go to zero or infinity. At some level below that, you would expect similar looking dynamics, and it would appear as though the pendulum has swung too far.
And to your point, there become distortions in terms of even, and the idiosyncratic aspects of a company being rewarded or punished, because everything just moves with the school of fish, and you don't really have the market rewarding the CEOs, the entrepreneurs in the proper way, or punishing them in the proper way, which has all kinds of other implications if you extend that out to the logical extreme on the efficiency of not just markets but capitalism overall.
Yeah, I mean, we've given a lot of power to ratings agencies, which led to 2008 to some degree, to a limited degree, and index creators, which is part of the problem that we have today. I know this is very tongue-in-cheek, but I almost wish someone would create an index with random weights, where the weights were changed every day so people couldn't find too much structure that would lead to instability over time. Not that I'm offering such a product or suggesting that people do it, but there's too much determinism in the system that can lead to instability. Too much rigidity.
Yeah, no, very, very, very well said. Okay, maybe for the remaining, 8, 9 minutes, again, everybody here, make sure you follow Hari on Twitter and obviously check out his books as well. Let's talk about survival for a moment, because I always go back to this point that sometimes the best thing you can do is survive, and you can't thrive unless you survive. And I've always been of the belief, and this kind of comes from my own being humbled in life, that the macro environment is what helps you thrive. The micro effort is what helps you to survive until the macro environment comes your way. Um, how should investors, whether it's retail, institutional, how should they think about surviving what could be a multi-year period of difficulty for making money against, what could be structurally higher inflation for the same period of time?
I think taking a broader approach to investing is probably a good idea. I know that I'm kind of jumping on the bandwagon here with trend following, which has done extremely well this year. But having a little component of trend in your portfolio can be very useful because it does provide some protection against outsized moves in various markets. It's statistical protection. It's not ironclad. Looking outside of bonds and especially stocks into other areas, I think will be very significant in the years ahead. I think we live in the US in a stock-oriented culture, a heavily equity-oriented culture, which is built up since the 1980s. If that were to change, I think investors would be very well served to think of other alternatives to get some return, participate, but not be too exposed to an extended bear market in stocks. That is not to say I'm predicting one, but if stocks went nowhere for the next 10 years, where is your return coming from? Especially if inflation remains somewhat high. So I think looking more outside of just stocks and to a lesser extent bonds, which are outside of the retail domain a bit more than stocks, would be very useful.
The implication there, though, as I think through that, is you probably wanting or needing to think about having things in the opportunity set which are relatively illiquid, right? So, like I've talked about farmland, right? And there are companies that can, essentially allow somebody to buy a portion of farmland. It tends to be uncorrelated. As much as I talk about lumber as an indicator, in the 30s, timber was one of the best performing asset classes during the Great Depression. But the commonality, I think, across all this stuff is that there needs to be a degree of an illiquidity premium to have that differentiated return stream. So, am I right in the way I'm thinking about that? I'm trying to frame it for the audience in terms of the idea of what do you do when perhaps all of your liquid options are acting the same.
Well, there are funds out there that have low minimums. I don't run such a fund, but which say trend following global commodities or mixed volatility strategies and trend following strategies and so on. And they are typically quite liquid and fairly accessible. They're quite liquid because they trade futures and forwards, and they're quite accessible because they have modest minimums I would not be keen to recommend any names, certainly, but if you look around, you will find fairly liquid investable strategies that move you a little bit outside of stocks and bonds into other arenas that may be profitable going forward. And I know that I don't want to oversell trend following because it's just a piece of a portfolio, but the good thing about trend following in these alternative markets is at least you have the comfort that in the absence of getting whipsawed again and again and again, there's only so much you can lose in any one position. And certainly there's only so much you can lose in one go. So that sort of thinking, I think, would be pretty useful. I also think shortening duration is a very attractive thing now, given the shape of the yield curve. So I would much prefer to be holding shorter maturity treasury debt and playing the yield curve a bit more and thinking about stocks perhaps a little bit less, and at the very least, if that's not hedgeable for a given client. So hedging is great. It's something I'm happy to discuss with anyone. It has its place. I'm a big believer in it, but also thinking in terms of moving into other areas is pretty attractive.
So part of that point about moving to other areas relates to the idea of lost decades, right? That ideally, you want to actually invest in something after a lost decade has already happened, right? Not when one is about to take place. And listen, we had essentially a lost decade plus with emerging markets. Now with this bond market sell-off, you've had a lost decade-ish with bonds from a total return perspective. Although most tend to obviously not reinvest the coupon, right? They use it for their own living expenditures. I'm curious. I don't know if this sounds far fetched, but I'm curious if there's a possibility in your mind that you could have the U.S. market to do nothing, and suddenly emerging markets, which everyone seems to have left for dead, if that becomes where you maybe have a surprise secular bull market, because this has been one of the areas of the investment landscape which has been, you can argue, a widowmaker, right? If you had any kind of momentum strategy on emerging markets, largely failed miserably because you didn't have any real persistent tailwind, and nobody seems to be of the belief that emerging markets can ever outperform the U.S.
Yeah, well, I mean, the widowmaker was historically shorting the Japanese government, and it's moved around over the years. I think that's a great idea. I just would caution the people against being too early in these things. Maybe wait for a little trend because there's so much catch up to be done anyway. So wait for the market to confirm your thesis, and then maybe do some of that. At least if you're not going to play options, I would say that's the best way to do it. Don't be the first one in. I mean, you don't get any prizes for being too early. You want to be in when you're fairly early, hopefully, when these secular changes occur, but where you have some tailwind in terms of price action, indicating that the flows may be gathering in your direction.
Yeah, no, I think that's spot on. All right, so again, everybody, I've taken a little bit too much of Hari's time here, but thankfully we were able to make this work. Please make sure you follow him. This will be an edited YouTube video in about a week or so, as well as available on all your favorite podcast platforms. Hari, not only am I thankful of you interviewing me for Top Traders Unplugged, but I'm glad I could at least somewhat return the favor because you're obviously wildly knowledgeable, and I hope the audience found value from this back and forth. So thank you, everybody. Thank you, Ari. I'll do another space at 3:30 with David, who's here in the space, and then again one with Chris Fenton and Leland Miller, China Page Book at 5 Eastern. Thank you, everybody. Thanks, Ari.
Thank you, sir.